Great. So we start right away, ladies and gentlemen. So the first thing you need to do in any CASNEB question is to look at the required part. So required, they want us to give them group statement of financial position as at 31st March 2022. So you know that is the part that I gave you as an assignment, if you remember. We said yesterday's assignment where somebody will be able to carry home today 1,000 bob. You guys were to do part B of the question till it balances. So and we shall be able to mark that this afternoon. So we are looking at the group statement of financial position as at 31st March 2022. So we read the whole question now. 𝐂𝐨𝐻 Limited has owned 70% of 𝐂𝐨 Limited equity share capital since 1st April 2017. The acquisition consideration consisted of cash amounting to 3,600 million paid on 1st April 2017. The retained earnings balance of 𝐂𝐨 Limited at the date of acquisition stood at 870 million and had no other reserves. The draft financial statements for the two groups for the year ended 31st March 2022 were set out below. So we have there statement of profit or loss and other comprehensive incomes for the year ended 31st March 2022. So I can see income statement, and then there beneath I can see statement of financial position as at 31st March 2022 for 𝐂𝐨𝐻 Limited, and then we have 𝐂𝐨 Limited. So additional information. A fair value exercise carried out on 1st April 2017 concluded that the carrying amounts of 𝐂𝐨 Limited's net assets approximated their fair values with the exception of an item of plant and equipment which had a carrying value of shillings 100 million below its fair value. As at 1st April 2017, the plant and the equipment had a remaining economic useful life of 10 years. Depreciation is charged to cost of sales. It is the group's policy to measure NCI at fair value at the date of acquisition. The fair value of the non-controlling interest in 𝐂𝐨 Limited on 1st April 2017 was estimated at 1,370. 3. 𝐂𝐨 Group adopts the revaluation model to measure its property, plant, and equipment as permitted by International Accounting Standards number 16 PPE. Revaluation surplus reported by 𝐂𝐨 Limited relates to the revaluation conducted in the post-acquisition period. Note 4. During the year ended 31st March 2022, 𝐂𝐨 Limited sold goods worth shillings 200 million to 𝐂𝐨 Limited. 𝐂𝐨 Limited still holds 25% of these goods in its inventory as at 31st March 2022. So we are told there, at 31st March 2022, 𝐂𝐨 Limited's records showed a receivable due from 𝐂𝐨 Limited of shillings 140 million, which corresponded with the balance in 𝐂𝐨 Limited's trade payables. An impairment review conducted on 31st March 2022 during our reporting period revealed that goodwill arising of 𝐂𝐨 Limited was impaired by 10%. No impairment loss had been reported in prior years. So they want us, ladies and gentlemen, to give them a group statement of financial position as at this date. So then let's get started, ladies and gentlemen. What do you think in this case here will be the very first thing for us to do in this question? Anybody who can tell me, what do you think in this case here will be the very, very first thing to do? We must understand the group structure. And this really is a very, very simple group structure, yes. So this is a very simple group structure. So the group structure, they have told us we have a company, the major company here is known as, 𝐂𝐨 Limited. So we have here 𝐂𝐨 Limited, which has acquired 70% of 𝐂𝐨 Limited. Yeah, 70% of 𝐂𝐨 Limited. So, ladies and gentlemen, where do you place this 70%? 70% is really so high. If I hold 70% of a company, then automatically I'm controlling. Yeah, I'm controlling. So this automatically means that it's more than 50%. So we are controlling. So 𝐬𝐭𝐤 is the controller, and the controller will always be called the parent. The controllee, the one that is being controlled, will be part of the parent. We call it a subsidiary. We call it a subsidiary. So this is really a very, very simple question, because we don't have in this case here like an associate, no. We only have a subsidiary in the question. So then please go ahead and give me the date of acquisition. When was 𝐻𝐻, this interest of 𝐻𝐻 Limited, when was it acquired? Yeah, if you read paragraph number 2, we are told the acquisition consideration consisted of cash amounting 3.6, paid on 1st April 2017. So this acquisition happened on 1st April 2017. Date of acquisition, 1st April 2017. How about the date of the financial statements given? Are you able to see financial statements given there? They are dated 31st March 2022. So of course, here I can't talk of number of months. This will be number of years. I can see from 2017 to 2022. These are number of years. So let's count. You see from the number line, if we are looking at having acquired this on 1st April 2017, yeah, so then our first year of operation will be ending on 31st March 2018. We have 31st March 2019, 31st March 2020, 31st March 2021, and then we have 31st March 2022. How many years do you guys get? I'm getting 5 years. 5 years. So number of years, they are 5. Number of years are 5 here. Number of years are 5. Now, ladies and gentlemen, once you've been able to ascertain your group structure, the next thing will be for you to get to know the value of the net assets of your subsidiary. Get to know the value of your net assets of your subsidiary. So right there, net assets of the subsidiary. So we have here net assets of the subsidiary known as 𝐻𝐻. So remember, you do this at acquisition. Here you prepare 2 columns. We have here at acquisition, and then we have here at reporting. At acquisition, and then we have here at reporting. At acquisition, then we have at reporting, 2 columns. Is there somebody who is able to remind us the components of net assets? Whenever you hear the word net assets, what comes to your mind? What are the components of net assets? Components of net assets, are you able to remember them? Yeah, like share capital. So we have here share capital, you're right. So we have here share capital. Yeah, we have in this case here, we don't have share premium in this question. So we have here share capital, you're right. Share capital. I would have comfortably in this case here brought share premium, but it's not there. So we have retained earnings. Retained earnings. We have retained earnings. So we start with share capital. Remember, it is the share capital of the subsidiary. We're evaluating the subsidiary. So you go to the column of the subsidiary, you will be able to see under equity, ordinary share capital under 𝐻𝐻 Limited. Go to the statement of financial position given there. Under 𝐻𝐻 Limited, you'll be able to see the ordinary share capital. Ordinary share capital. How much do we have there, ladies and gentlemen? How much do we have there? Ordinary share capital. Yeah, 3,000, isn't it? Our figures are in the millions. So it shall be at acquisition, 3,000. Remember, share capital of a subsidiary doesn't change. Share capital of the subsidiary will always remain the same. So share capital here at acquisition is 3,000, 3,000 as well at reporting. If you look at the share premium of the subsidiary, there is a dash there. Share premium of the subsidiary is a dash, 0, nothing. So we go to retained earnings. Retained earnings, I've been told, if you go to the very beginning of the question, paragraph number 2, we are told the acquisition consideration consisted of cash amounting to 3,600, paid on 1st April 2017. The retained earnings balance of Twende Limited at the date of acquisition, retained earnings at the date of acquisition is 870. Remember, retained earnings doesn't keep on dancing. Retained earnings dances, retained earnings changes. It can never be constant. So retained earnings, the examiner is very, very good. He has given us retained earnings at acquisition as 870. And then now we have retained earnings at reporting. How much was reported in the statement of financial position to be the retained earnings of the subsidiary? What is the retained earnings of the subsidiary from the financial? How much retained earnings was reported, ladies and gentlemen? Retained earnings in this case are reported. 2530, isn't it? So this is what was reported. Retained earnings reported is 2530. Thank you so much. Thank you so much. 2530 is what was reported. So we continue. What else do we have, my great friends here? My great friends here, we have what we call fair value uplift, fair value adjustment. So you write here, fair value adjustment. Fair value adjustment. Yeah, fair value adjustment. So this fair value adjustment, the fair value adjustment, what have they told us? Go to additional information number 1. Additional information number 1. A fair value exercise carried out on 1st April 2017 concluded that the carrying amount of Twende Limited's net assets approximated their fair values with the exception of an item of plant and equipment which had a carrying amount of shillings 100 million below its fair value. Below its fair value. Yeah, so I can see fair value adjustment of an asset that belongs to the subsidiary. Remember, this is net assets of the subsidiary. Yeah, during acquisition, we are told a fair value exercise carried out on 1st April 2017 concluded that the carrying amount of who? Twende Limited, subsidiary. Twende Limited. Net assets approximated their fair values with the exception of an item of plant and equipment which had a carrying amount of 100 million. Yeah, below its fair value. So then I would want you to tell me, this 100 million, of course, I'll be able to have it here. Yeah, it doesn't change, eh? The fair value uplift will be the same here and here, 100. But now the question is, will I leave it as a positive or should I put it in brackets as a negative? In short, I'm asking you, is this a fair value uplift or a revaluation downwards? Is it a revaluation up or a revaluation down? According to your understanding. Remember, whenever the fair value is higher, then that is an uplift. That's an uplift. Whenever fair value is higher, you should never be treated by some of those terms like down. No. You ask yourself, during this revaluation, where do we have, or rather, which metric is higher? If fair value is more, then it will be called an uplift. It will be called an uplift. If fair value is smaller, it will be called a down lift. You're going down. So in this question, ladies and gentlemen, what are we told here, ladies and gentlemen? We are told, I'm reading again, note number 1, a fair value exercise carried out on 1st April 2017 concluded that the carrying amounts of Twende Limited net assets approximated their fair value, with the exception of an item of plant and equipment which had a carrying amount of 100 below its fair value, meaning that the fair value is more than the carrying amount. Yeah, so then once I have this uplift like that, we must come here and do what we call depreciation on this fair value adjustment. So let's do this depreciation on the fair value adjustment. You will need some working space. You need, in this case here, some working space where you'll be able to come and give us a working on this depreciation. Yeah, depreciation on fair value adjustment. Remember, the adjustment itself is 100. Have they given me the remaining useful life? After they did this revaluation, of course, they must give you the remaining useful life. So at 1st April 2017, I'm reading note 1, second sentence. At 1st April 2017, the plant and equipment had a remaining economic useful life of 10 years. 10 years. So then I should be able to get, in this case here, the depreciation per annum. And then remember, we normally calculate this for the number of years or number of months you've stayed with the subsidiary. We call it post-acquisition. After acquisition, I'm aware that I've stayed with this subsidiary for how many years? For 5 years. You've stayed with this for 5 years. So depreciation on fair value adjustment will be equal to how much, ladies and gentlemen, here? Will be equal to how much, ladies and gentlemen? 50. 50. Remember, the remaining useful life is 10. And if you came in earlier, when we did the group structure, we were able to count the number of years. From the time we acquired the subsidiary to the reporting date, it is 5 years. It's 5 years. 5 years. Now listen, whenever, ladies and gentlemen, this is an uplift, if these figures are positive, it means that this depreciation here you will subtract. Because I've seen somebody saying somewhere that it's an overcharge. No, no. Yeah, this basically means that this amount was not put in our books. It wasn't depreciated. But if you don't want to confuse, the very best thing, ladies and gentlemen, is to know that this one here will be able to come here and put it in brackets like that. And remember, it's post-acquisition. So post-acquisition, it cannot be there. Yeah, depreciation on fair value adjustment. Do we have any other fair valuation that was adjusted? Please look at note number 3. Look at note number 3. 𝐂𝐨𝐮 Group adopts revaluation model to measure its PPE as permitted by International Accounting Standard IAS 16 PPE, revaluation surplus reported by 𝐶𝐻, who is our subsidiary. Revaluation surplus reported by 𝐶𝐻 Limited relates to revaluation conducted in the post-acquisition period. Yeah, so if you look at, in this case here, look at the statement of financial position given. If you look at the statement of financial position given, is there somebody who is able to see revaluation surplus of 𝐶𝐻? Because we are doing revaluation, we are doing net assets of the subsidiary 𝐶𝐻. Look at the statement of financial position provided. Is there somebody who is able to see revaluation surplus? Anybody who is able to see the revaluation surplus? How much is it? Revaluation surplus. How much is it? Revaluation surplus. How much is it? Wait, they're not talking to me. Revaluation surplus is 700. Yeah. And they're telling you that that revaluation surplus, this is fair value adjustment for revaluation surplus. Revaluation surplus, which in this case here at acquisition, it will be 0. It will be 0. Here, it will be 700. Why is it 0 here? Because they have even told you categorically that this revaluation surplus that happened is post-acquisition. It is post-acquisition. Let's read this because I want us to be together. I want us to be together, ladies and gentlemen. I want us to be together. We are told, note number 3, 𝐂𝐨𝐮 Group adopts revaluation model to measure its PPE as permitted by International Accounting Standard number 16. PPE. Revaluation surplus, which is an equity component. Remember, revaluation surplus belongs to the owners of the company. And anything that belongs to the owners of the company will be an equity. So this is equity. This is equity. So we are told there, 𝐂𝐨 Group adopts the evaluation model to measure its PPE as permitted by International Accounting Standards number 16, Property, Plant and Equipment. The evaluation surplus reported by 𝐶𝐻 Limited relates to the evaluation conducted in the post-acquisition period. If that concept wasn't there that it was conducted in the post-acquisition period, then I would have had year 700 and year 700. But you see now, this revaluation happened post-acquisition. It wasn't exactly at acquisition. It was conducted after. It is post-acquisition. Now, ladies and gentlemen, I've been able to factor in very, very important components of net assets. However, there is one component we are yet to do here. Is there somebody who can tell me which component do you think in this case we need to bring here? And why? And why? Which component do you think will be very, very important? NCI can never come to net assets. No. NCI can never come to net assets of the subsidiary. Never. But thank you for trying. But it shall never come here. Remember, NCI goes under equity in the balance sheet, in the statement of financial. Thank you, JJ. JJ is saying UPS, especially when it is bottom up, isn't it? When sales were from the subsidiary to the parent. Yeah. If the internal sales made within the group are such that it is the parent that sold, or rather, it is the subsidiary that sold the parent, that one is an upward stream. Upward stream. Yeah, upward stream or just upstream. Let's read note number 4. Let's read note number 4. So note number 4, what are they telling us there? During the year ended 31st March 2022, 𝐶𝐻 Limited sold goods. Who sold? 𝐶𝐻. Who is 𝐶𝐻? A subsidiary. 𝐶𝐻 sold goods, 𝐶𝐻 sold goods, 𝐶𝐻 sold goods worth 200 million to 𝐂𝐨 Limited. So I can see this concept of what here? Upstream. Because you see, we have 𝐂𝐨 here. We have 𝐂𝐨 here. And then we have 𝐶𝐻 here. So when 𝐶𝐻 sells against, when 𝐶𝐻 sells to 𝐂𝐨, that's against. So this is upstream. And if it is upstream, then it must be featured on the net assets. Because it's a fake equity. It's a fake equity. So come and give us UPS and realized profits on stock, and realized profits on stock, given that in this case here, this is what here? It is upstream. Given that it is upstream. Upstream means that it is the subsidiary that sold. Whenever you hear the word upstream, upstream means that the sub sold to parent. The sub sold to who? To parent. The sub sold to parent. And UPS stands for unrealized profits on stock. Is there somebody who is able to remind us the formula of UPS? Is there somebody who is able to remind us the formula of UPS? Formula of UPS? Anybody who is able to remind us the formula of unrealized profit on stock? Unrealized profits on stock? Yeah, it is profit margin times REIS. It is profit margin times remaining internal sales. Profit margin times remaining internal or intra. Thank you so much. So anytime they want us to give them UPS, we shall always take profit margin times remaining internal sales. Remaining internal sales times remaining internal sales. Now, ladies and gentlemen, let's do this together. We are told in note number 4. Note number 4. So for those who are taking notes, you should be able to write here. This is note number 4 we are using to get this UPS. To get the UPS. So we are told in note number 4, during the year ended 31st March 2022, 𝐶𝐻 Limited sold goods worth $200 to 𝐂𝐨 Limited. 𝐶𝐻 Limited reports a gross profit markup of 25% on all its sales. So instead of this gentleman giving me profit margin, he has given me profit markup. So what do you think will I do to be able to get profit margin whenever you're given profit markup? What I know is that the margin has got a bigger base. Bigger base. Waswahili wanasema kwamba margin iko na makalio kubwa. Yeah. So if markup is 25 over 100, margin iko na base kubwa. Base yake ni kubwa. Numerators will remain the same. Numerators will remain the same, but the base here. So you'll be able to talk of 25 over 100 plus 25. So this gives us 25 over what here? Over 125. Yeah, thank you, Nekesa. Great. Great. Are we together, ladies and gentlemen, regarding this? Are we together regarding this? Yeah, as Nekesa is telling us there, that if markup is A over B, then margin will be A over A plus B, because you must increase the base of the margin. You must increase the base of the margin. You must increase the base. This is so important for you. Yeah. So up to here, ladies and gentlemen, are you guys able to follow somehow? Are you guys able to follow somehow up to here? Are you able to follow somehow? Thank you so much. Thank you so much. So then we get back here, and please, I hope you are taking the very best notes. Let's get back here and get this and realized profits on stock. So then this will be 25. This will be 25, yeah, times, in this case here, the remaining internal sales. Remember, the total internal sales was 200. The total internal sales was 200. Note number 4 tells us during the year ended 31st March 2022, Twende Limited sold goods worth 200 to Kuja Limited. Then Twende Limited reports a gross profit markup of 25% on all its sales. Kuja Limited still has 25% of these goods in inventory. So out of the 200, 25% are still withheld in inventory. So then could you kindly go ahead and give us this figure? The UPS will end up giving us what figure here? According to Grace, she's getting a figure of 40. A figure of 40. Grace, are you sure it's 40? Because you see a quarter of this. This is supposed to be 25 over 1, sorry, 25 over 125, sorry for that. 25 over 125 times 200. Yeah, so in this case here we are getting 10. We are getting 10. So remember, this is fake equity. Because when this company that sold, when the company in this case here that sold to this particular what here, when Twende sold to Kuja, they realized this 10 as profit. And because this 10, which is its profit, is within the group, the goods have not left the group. They have wrong equity. They have wrong equity. So we need to correct here. So come and give us UPS. Upstream is 10. You are deducting like that. That is it. So go ahead and give us the total net assets now at acquisition and at reporting. Give us the total net assets at acquisition and at reporting. Give us the total net assets at acquisition, you add, and at reporting. Somebody give me these figures. At acquisition, JJ is giving me a figure of 39.70. Thank you, JJ. 39.70. 39.70. I think today JJ deserves my lunch, to be very, very honest. Yeah. At acquisition, we have here 39.70. How about at reporting? You take 3,000 plus 25.30 plus 100 minus this 50 plus 700 minus 10. Maureen and JJ again, they're giving me a figure of 62 at here, 62.70. 62.70. So having gotten those two numbers, what do you think will be the next step? Having gotten those two numbers, having gotten those two numbers, what do you think will be the next step? Thank you so much, Pharrell. we should be able to get what we call post-acquisition profits. We should be able to get what we call post-acquisition profits, PAP. We should be able to get what we call the famous PAP. So we have here PAP. So post-acquisition profit will be equal to this 62.70 now minus 39.70, which will end up giving us how much here, the post-acquisition profit. How much do we have, my good students? 2,300. 2,300. Please mark this total equity at acquisition. This is very, very important for us. Now, the next working is known as goodwill. 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 So go ahead and give us goodwill. Do you still remember the approach to getting this goodwill? The approach to getting this goodwill, you'll be able to give us the consideration paid by the parent. Paid by parent. Then we have here consideration paid by NCI. Yeah, like that. And then you come and less net assets of the sub at acquisition. Net assets of the sub at acquisition, already we have this figure, and then we'll be able to get what we call goodwill. Goodwill at acquisition, you less impairment loss. You less impairment loss. And then you'll be able to give us goodwill at reporting. You'll be able to give us goodwill at reporting. Goodwill at reporting like that. You'll be able to give us goodwill at reporting like that. Let me know once you're able to put down this pro forma. Once you're able to put down the pro forma, please put your thumbs up like this. Put your thumbs up like this live. Put your thumbs up like this live. After all, you guys have now gotten used to this. After all, you guys have gotten used to this. Yeah. Goodwill, you look at consideration paid by the parent, look at consideration paid by NCI, then you less net assets of the subsidiary at acquisition to get goodwill at acquisition. And then you less impairment loss, and then you give me the goodwill at reporting. I'm waiting to get your thumbs up or just a Y for yes, that Mwalimu now we are together. A Y for yes, that Mwalimu now we are together. Thank you so much, Nekesa. Thank you so much. So then let's look for these considerations here. Let's look for these considerations here. Yeah. So we have here consideration done by who? By the parent. So consideration of the parent. Note number one, the parent paid how much? We are told, actually, not even note one, it's given there at the very beginning, paragraph 2. The acquisition consideration consisted of cash amounting to 3,600 paid on this date. Kuja paid 3,600. And then, of course, they never bought 100%. They only bought 70%. 30% was bought by someone else. This person gave us some consideration. So the NCI, they always give you the policy of NCI. And this has been given on note number 2. It is the group's policy to measure NCI at fair value at the date of acquisition. The fair value of this NCI is what they paid. Fair value means market value. And you can see the market value there is 1370. Then come and less net assets at acquisition. So net assets at acquisition, ladies and gentlemen, are you able to see the table that you have done up there? How much do we have there as net assets at acquisition? If I'm not wrong, it was 3970. Yeah, thank you so much. So subtract like that. Then you should be able to give us what we call goodwill. Goodwill at acquisition. How much do we have here as goodwill at acquisition? Yeah, so you're taking this plus this. You add and then you subtract this. So somebody is telling me 1,000. So remember, this is an intangible asset. Depreciation of intangible assets, we call that one impairment. So come and give us here impairment loss. The impairment loss has been factored in. Note number 6. Note number 6. An impairment review conducted on 31st March 2022 revealed that goodwill arising of 20 Limited was impaired by 10%. So impairment loss is 10% of the goodwill at the beginning, which is 1,000. So this gives me 100, and therefore goodwill at reporting. Goodwill at reporting will be 900. So this is what shall go to the statement of financial position. This is what shall go to the statement of financial position. Could you kindly confirm, ladies and gentlemen, that we are together? You know, you're my children, eh? I must take care of you. If I don't take care of you today, when I become old, will take care of me. I want to take care of you. Very good care of you today. When I become old, you'll be bringing a Mercedes-Benz, big one. Yeah, say, this Mwalimu, he loves Mercedes-Benzes. Yeah, great. Thank you so much, Milia. 10%, it's given in note number 6. Note number 6, an impairment review conducted on 31st March 2022 revealed that goodwill arising of 20 Limited was impaired by what year? Was impaired by 10%. I hope you're able to see that. Janet, 10%. All right. Now, ladies and gentlemen, the next working will be NCI. NCI. So go to non-controlling interests. So go to non-controlling interests. Very easy, because already I have the starting figure of NCI. It is 1370. So we have NCI working. So we have NCI at acquisition. So at acquisition, NCI was 1370. All right. What do we give these crazy ninjas? Our smaller brothers in the group, what do we give them? Do we just leave them hanging like that? We give them their share of post-acquisition profit. So add share of post-acquisition profit for the NCI. Don't forget that Kuja and the 20, this one here was 70%. And then, of course, we must be having 20 now has another owner. Yeah, who has a smaller interest, 30%. Because the two must always add to 100%. Yeah, so it will be add share of post-acquisition profit, which will be 30%. Is there somebody who is able to remember, ladies and gentlemen? Is there somebody who is able to remember what the post-acquisition profit was? Total post-acquisition profit likuwa ngapi? Total post-acquisition profit likuwa ngapi? Yeah, 2,300, isn't it? Yeah, 2,300. Thank you so much, 2,300. You are adding this, but now remember, later on, post-acquisition, later on, we have goodwill, which was impaired. That loss has to be shared by the two owners. That's what I wanted to bring out with this question. That was the only tricky thing with this question. So what is 30% of 2,300? 30% of 2,300 gives us what figure? 0.3 times 2,300. This gives me 690, and there is a loss that accrued later on. We must share with these people. They are young brothers, but we have to share with them. Whenever we make a profit, we share with them. Whenever we make a loss, we share with them. Like now here we have here less share of impairment loss. Impairment loss. Which impairments? Impairment? Goodwill. It was impaired. So it will be still 30% of that. Is there somebody who is able to remember that the impairment loss was 100? Impairment loss in total, it was 100, eh? Impairment loss in total was 100. Yeah, so 30% of this 100, this will be 30. This will be 30. So if you subtract this plus this minus this, we shall be able to get NCI at reporting. We shall be able to get NCI at reporting. So NCI at reporting will be equal to what? NCI at reporting will be equal to what here? At least for listeners we are following. So NCI at reporting will be equal to how much? 2030. 2030. Now, 2030 is very, very good. 2030 is very, very good. I normally don't do the group retained earnings working, but for this one, just allow me to do it. Yeah, for this one alone, because of this goodwill impairment, just allow me to do it, but we don't do it in an exam. I'll be able to show you a shortcut that this retained earnings will always be the balancing figure. So come here and do group retained earnings. So groups retained earnings. Yeah, groups retained earnings. So under groups retained earnings, we shall start with the parent. Yeah, so we have in this case, ladies and gentlemen, we have here the parent. So who is the parent? So we have here Kuja, retained earnings. These ones, of course, for the group, their hours 100%. Yeah. So you pick this the way it is, Yeah, you pick this the way it is. So please go to the retained earnings of the group. Go to the retained earnings of the group. So retained earnings of the group, ladies and gentlemen, what do we have there? Are you able to see the retained earnings of the parent? I mean, the parent. These guys don't want to talk to me. They don't want to talk to me. They don't want to talk to me. How much do we have there, ladies and gentlemen? Is there somebody who is able to see 4170? Ah, 4170. And then now remember, for the subsidiary, we can only share the PAP. Don't bring in this case here like 20 days retained earnings, no. So for the subsidiary, you give us add share of PAP from subsidiary. Remember, subsidiary can only take 70%, isn't it? We can only take 70%. So 70% of what? 70% of what? Yeah, 70% of what here? 70% of what? Of 2300, isn't it? Of 2300. Could you kindly give me this figure? 70% of 2300, which will end up giving us what figure? Somebody here. Yeah, they're giving me a figure of what here? 1610. They're giving me a figure of 1610. 1610. Thank you so much. Now, ladies and gentlemen, after you give me that figure, then I would expect you straight away to come and give me the share of what here? Give me the share of impairment loss. Share of impairment loss. Share of impairment loss. Share of impairment loss. So remember, the impairment loss was 100. We are only taking up 70%. You're only taking up 70%. So 170, this gives us 70 like that. You are subtracting. So then we should be able to give them, in this case here, the groups, retained earnings, in this case here at reporting, which will end up giving us what figure? Which will end up giving us what figure? Which will end up giving us what figure? $57. They're giving me a figure of 57.10, right? They're giving me a figure of 57.10. They're giving me a figure of 57.10. They're giving me a figure of 57.10. Now from there, I don't know whether you'll be able to allow me to fix the balance sheet very fast in 10 minutes. Please allow me to fix the balance sheet here very fast, just in 10 minutes. Is it okay? Yeah, let me fix it up. And it has to balance. It shall always balance. It shall always balance. Always. It shall always balance. Always. We cannot do workings which are not balancing. So then we go to our statement of financial position. Statement of financial position. So statement of financial position. Yeah, so the name is supposed to be, the name here is supposed to be 𝐂𝐨𝐻 Limited. 𝐂𝐨𝐻 Group. Yeah, so 𝐂𝐨𝐻 Group. So this 𝐂𝐨𝐻 Group, we have here group statement of, so we have here consolidated. Call it consolidated statement of financial position for the period, no, as at 31st March 2022, like that. Yeah. So then pretty fast, ladies and gentlemen, what do we have here? Pretty fast, ladies and gentlemen, what we have here is this: assets. We start with non-current assets. So we start with non-current assets. So these non-current assets, what are we given there? For the non-current assets, ladies and gentlemen, we have the first one is PPE. Remember, our case is to add. When you are consolidating, you are adding, you are putting things together. So we have property, plant, and equipment. So we have here property, plant, and equipment. You take the one of the parent. The one of the parent I can see is 5,300. 5,300 plus the one of the subsidiary, which is 50/50. Which adjustment should I bring here? Which adjustment should I bring here, ladies and gentlemen? Which adjustment should I bring here, ladies and gentlemen? Do you remember the PPE fair value adjustment? Do you remember the PPE fair value adjustment that you did in your net assets? PPE fair value adjustment. Do you remember that? PPE fair value adjustment. If I remember very well, that was an uplift of 100. And then, of course, this 100 was not depreciated. So we have the depreciation on the fair value adjustment, which is 30. So please give me this answer. Which is 30. Please give me this answer. How much do we have here? Chris is saying 50. It's 50, eh? Sorry. I'm being told it's 50. Sorry for that. I don't know where I'm getting 30 from. 50. So minus 50. So then how much do we have there, ladies and gentlemen? Kindly give me a minute. So in this case here, they are giving me 10,400. I'm calling you back. Okay. So they're giving me a figure of 10,400, right? They're giving me a figure of 10,400. Now, ladies and gentlemen, unlike the other questions that I've been doing with you, there is something interesting here. If you look at the balance sheet given, 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 they have given us something very, very interesting there. They have given us investment. That 𝐂𝐨𝐻 Limited has an investment of how much? 4,500. Remember, 𝐂𝐨𝐻 does not have associates. 𝐂𝐨𝐻 in this case here does not have, 𝐂𝐨𝐻 Limited, the only serious investment that we have here is what we are calling our subsidiary. All right. So in the group, they haven't shown us like whether we have it's only the subsidiary. But you see, this subsidiary never cost them 4,500. The subsidiary, the investment they did to the subsidiary was worth how much? If you look at the first paragraph, second paragraph actually, the acquisition consideration consisted of cash amounting to 3,600 million, paid on 1st April 2017. Yeah, so you can see in this case here, they invested 3,600. But if you look at their balance sheet, it is recording an investment of 4,500. So then in this case here, these ninjas must be having, of course, we have subsidiary here. We have subsidiary, which we don't bring. We can't bring subsidiary. We said whenever you see investment in a subsidiary, you shall only talk of goodwill. So please, this subsidiary should be able to strike it off as an investment. So in short, here we have got two investments. We have two investments. Out of the 4,500, we have an investment called subsidiary. Subsidiary is 3,600. Then we have another investment. We have other investments. So these other investments will be 4,500 minus 3,600. So for the subsidiary, I'm going to cancel this, and then I call it goodwill. So goodwill to be reported. Is there somebody who can give me the goodwill to be reported? Somebody please give me the goodwill to be reported, because I can't have like investment in myself. So goodwill to be reported, they're telling me it is 900. Then now we have the other investments that we shall be able to bring here. So we have other investments. We have other investments that we should be able to bring here. These other investments, ladies and gentlemen, they are worth how much now? They'll be worth 4,500. 4,500 minus this 3,600. How much do we have there, somebody? If you look at all the questions, Chris, that you have, when you take in this case here, like the amount reported as a total investment, you subtract investment in a subsidiary, investment in associate, it cancels. But now this one is not canceling fully. So it means that we have other investments that we shall be calling financial instruments. We have other investments that we shall be calling financial instruments here. So can you kindly give me this figure here, ladies and gentlemen, before I repeat on this? So other investments, how much? 4,500 minus 600. I'm being given a figure of what here? I'm being given a figure of 900. I'm being given a figure of 900. I'm being given a figure of what here? I'm being given a figure of 900. 900. 900. So then go ahead and give me the total non-current assets. Go ahead and give me the total non-current assets. Total non-current assets. So go ahead and give me the total non-current assets. Are you able to add them? As I repeat, Lisa, so how much do we have here? I'm being told it's 12,200. Remember, ladies and gentlemen, that we did a revaluation of our assets. In note number one, we had a fair value uplift. So when you uplift your assets, what do? They increase in value. So you add. And then, of course, ladies and gentlemen, you'll be able to come and do what here? Subtract that 50. You subtract that 50 like that. Now that makes some sense. That makes some sense. Now, ladies and gentlemen, from that, I will be able to go straight away to our current assets. We shall be able to go to our current assets. So we go to our current assets here. Very easy. Current assets. So current assets, what do we have here? The first item that we have here under current assets is known as inventory. Is known as inventory. So inventory, what do we have here, my great students? So under inventory, what I can see that we happen to be having around under inventory, what we have under inventory, for the parent, it is 2840 plus. For, in this case here, the subsidiary, we have 1560. Subsidiary, we have 1560. Which adjustment do you expect us to have here? Which adjustment do you expect to have? Joy, thank you so much. Unrealized profits on stock. Unrealized profits on stock. So the unrealized profit on stock, ladies and gentlemen, how much was it? We subtract because it's fake profit, isn't it? It's fake profit in our inventory. Remember, our inventories, they are not supposed to be having any profit in them. Remember IAS 2. Inventory shall be kept at cost. So minus 10. So inventory minus 10. So is there somebody who can easily give us this figure? Anybody who can easily give us this figure? 2840 plus 1560 minus 10. Somebody give us this figure, inventory. Inventory. Oh, they're not talking to me and I don't have the time. $43.90, 43.90 inventory, 43.90. inventory 4390, inventory 4390. And then, ladies and gentlemen, we go straight away to receivables. So we have group receivables. Group receivables, we have a group receivables, group receivables. So for the group receivables, what do we have here? So group receivables, I can see for the parent company, 2480. 2480 plus, 2480 plus, 2480 plus. In this case here, we have for the subsidiary 1860. 1860, we subtract. 1860, we subtract what here? Do we have any fake receivable? A receivable within the group? Do we have a receivable within the group? Do we have a receivable within the group? Yes, we do. Yes, we do. A receivable within the group, ladies and gentlemen, that we have is in note number 5. At 31st March 2022, Twende Limited's records showed a receivable due from Kuja Limited. My wife in the morning tells me, Mwalimu, give me 100,000. I know that is within family. Yeah, so I know that that's a fake receivable. I will never receive it. I will never receive that money, at least for her. If I'm the one who asks money from her, at least for her money must always go back. Her money must be paid, because she'll give you reasons to believe that that money is not in the family. It's not coming from the family. That money is coming from Chamas, etc. Her, she can continue putting it there as a receivable or as something. But for me as a husband, when I give her, straight away, that's a fake receivable. I will never receive. I will never receive. So that 140 is fake. So minus 140. Minus 140. So are you able to give me, ladies and gentlemen, that one at the end of the day will give me what figure? That one will end up giving me what figure? Yeah, so they're giving me a figure of what here? They're giving me a figure of 4,200. From there, we have cash and cash equivalents. So cash at bank, or cash and cash equivalents. So cash at bank, yeah. So basically it's group consolidation, right? Group consolidation. And the question is an FRA question, which I'm finishing, which is August 2022. August 2022. Yeah, question number 2. Question number 2, FRA. Yeah. So cash at bank, no adjustments, because in this question, there is no cash in transit. There is no cash in transit. So in this question, what do we have there? In this question, what do we have there? You can see cash and cash equivalents, 1780 plus 1030. So 1780 plus 1030, which will end up giving us what figure, ladies and gentlemen? 1780 plus 1030 will end up giving us 2810. 2810. 2810. So please go ahead and add for us. Give us total assets. Give us total assets. Give us total assets. So total assets in this case here will be 23,600. 23,600. Yeah, so please come here and double underline. Then we shall be able to go ahead and look at how has this been financed. How has this been financed? So we look at equity versus what here? Equity versus, so please mark this figure. Mark this figure 23,600. Mark that figure 23,600. All right. Now, ladies and gentlemen, please listen and listen to me very well. Now we are looking at the financed by the equity and liabilities. So we start with equity. Equity, 3 marks. So under equity, we shall start with share capital. What do you know about share capital in group consolidation? What do you know about share capital in group consolidation? We shall only take which one? parent only. So we have here parent only. Yeah, the figure of the parent, no share exchange here. So the ordinary share capital is 5,000. This is a free mark automatically. Then we have share premium. Then we have share premium again for the parent. Are you able to pick it yourselves? Are you able to pick yourselves? Thank you, Grace. Thank you, Pius. Thank you, Chris. Thank you, Millie. Yeah, thank you, Mercy. Thank you, Millie Kaku. Yeah. So again, share premium is for the parent only. How much do we have there, ladies and gentlemen? Yeah. So in this case here, share premium, we have 1,000, isn't it? Do we have any other? It's called revaluation surplus. So we have here revaluation surplus. So revaluation surplus, how much do we have there, revaluation surplus? So you have to be very, very careful with this revaluation surplus. So revaluation surplus, remember the parent of 1550. I can see the subsidiary, this subsidiary had a revaluation surplus of 700. But now remember, ladies and gentlemen, that in this case here for revaluation surplus, this 700 here belongs to two people. The 700 here belongs to two people. So this is post-acquisition. It arose after acquisition. And any profit or retained earnings or revaluation surpluses that arise after acquisition, you must share. You must share. So in this case here, you can only acknowledge 70% of this. You can only acknowledge 70%. So meaning that our group retained earnings figure is wrong. I'll be able to show you why I'm saying it's wrong. Yeah, that figure is wrong. So can somebody give me this one here? 1550 plus 700 times 70. Remember, this arose after acquisition. After acquisition. What amount do we have here, ladies and gentlemen? 2040, right? I'm being given a figure of 2040. I'm being given a figure of 2040. 2040. 2040. 2040. Is that okay, ladies and gentlemen? For revaluation surplus, you have to be very, very careful because there is a revaluation surplus that came after for the subsidiary. It came after acquisition. This 700, if I read, remember the 700, what have they told us in note number 3? Kuja Group adopts the revaluation model to measure its PPE. Yeah, and then the revaluation surplus reported by Twende Limited relates to the revaluation conducted in the post-acquisition what year period? In the post-acquisition period. All right. So that's 700. The one that is marked there, 700, is post-acquisition. You just have to do what year to share it out that way. You must share it out that way. Now, that means that, and that is why I always tell my students here not to do the working of retained earnings. Don't do it. Not unless you are very, very good with group consolidation, don't do retained earnings working. Remember, we did the retained earnings working. We did the retained earnings working here. Yeah. If you remember, don't write here. Let me just write here something. Yeah. Remember, we had retained earnings, group retained earnings. We had a group retained earnings. Yeah. And we took, in this case here, for the parent, 100%. We took a figure of what year? And then we said, share of what year? PAP. So share of PAP, in this case here, we have 70% of 2,300. Do you remember that? 70% of 2,300. Yeah, which gave us what figure? Somebody as I finish and then I award your present. I would want to award your present. So 70% of 2,300. Yeah, so this gave us how much, ladies and gentlemen? It gave us 1610, eh? So this is now wrong. The moment you come, you know, this 700 was well within this PAP. The 700 was well within the net assets. Yeah, it was built into this. And that is why I don't want, and this will never give even a single mark. Yeah, now that you've been able to bring this figure separately, a 700 separately, then it can only work if you come and deduct it here. There are two ways, but because I don't want to get into really a lot of issues to do with the group retained earnings. Yeah, so this 700 has already been factored in here separately, so I have to subtract it from here. So could you kindly revise this working for me? Say 70% times, this one I think will give me 1600 or something. 70% times 1600, which will give me how much? Please give me this figure. 70% of 1600, because you see the body mass, 2300 minus 700, yeah, so this gives me 1110. So you see, for an ordinary student who is working under examination pressure, you will not be able to really do this in your exam. Yeah, and I'll be able to show you today how these exams are marked. All right, so this is supposed to be 1120. Don't forget that the goodwill impaired will still remain the same. Yeah, so loss, impairment loss. Impairment loss. So the impairment loss will be 70% of that 100, which is 70. Can you kindly give me the revised goodwill? Not goodwill, but revised group retained earnings. Please give me the revised group retained earnings. So according to JJ, she's getting 4170. JJ, check again. This plus this minus this. 5150, not yet. Joy is getting 5220. Check, JJ, as we finish. 5220. 5220. So this working, you will never get anybody doing this working in an exam. And nobody will ever compel you to do it. It normally comes as a balancing figure. But because you've done it, then let's go ahead and acknowledge. Let's go ahead and acknowledge, ladies and gentlemen, let's acknowledge our group retained earnings. So we have here group retained earnings. I'm following that order. So we have group retained earnings. Group retained earnings, 5220 here. Sorry for that. 220. Do we have any other source of equity? Do we have any other source of equity that you guys are able to remember? NCI. So we have here NCI. NCI, we have already calculated this NCI, and NCI gave us what amount? Already we have this NCI. So NCI gave us what amount? Was it 2030? Well, these things are lost now. 2030. 2030. So let's go straight away to liabilities. And liabilities, I would want us to look at non-current liabilities. So we go to liabilities and start with non-current liabilities. Start with non-current liabilities. So we have here non-current liabilities. So the non-current liabilities, what do we have here, my friends? The non-current liabilities that I'm able to see here pretty fast, we have here 10% loan notes. 10% loan notes. How much do we have there? I can see for the parent is 1700. 1700 plus 1050. 1700 plus 1050, which will give me how much? No adjustments at all. These are free marks. So I'm being given a figure of 2750. 2750. And then we have in this case here what they are calling deferred taxation. No adjustments at all. So we have here deferred taxation. So deferred taxation, how much? 750. 750 plus 570. Yeah. Can you kindly give me these figures we finish? So deferred tax, they're giving me a figure of 1310, isn't it? 1310. Oh, is it 1210 or 1310, Joy? 1310. Thank you so much. Apart from that, we have other equities that we are calling current liabilities. So we have here current liabilities. I can even go ahead and just call them here current. So we have here current liabilities. So current liabilities, what do we have here? Two of them. I can see we have trade payables. So for 2340 plus 1300. Is there somebody who can remind me something small about this? Payables? Anybody who is able to remind me something small? Thank you so much, JJ. She's able to remember that within the group, we have a fake receivable, and there must be another party in the group saying that I have a fake payable. Fake payable, yes, minus 140. Minus 140. So are you able to give me this figure? Are you able to give me this figure, my good students? Are you able to give me this figure, my good students? Yeah. So they're giving me a figure of 3,500. 3,500. Thank you so much. And then we have this other very last one, which does not need any adjustments, free marks. So we call it what here? We call it taxation. So taxation, I can see a figure of 400. I can see a figure of 400. I can see a figure of 400 plus, yeah, a figure of 400 plus what here? 400. In this case here, 400 plus 350, which will end up giving me what figure? 400 plus 350. Yeah, which gives me 750. And then that will be it. So come here, ladies and gentlemen, and then you give me, come here, ladies and gentlemen, and then you give me the total equity, and liabilities. Add them up, all of them. Add them up, all of them. From here, the top. From here, the top. From the very top, 23,600. 23,600. 23,600. 23,600. The other option, although it's not right, that you would have done, you could have also said that for evaluation surplus, you're going to consider for the parent only. So you take this as 1,550 here. All right. And then now group retained earnings, you can now easily work with that figure like that. But I don't want us to go into these issues because of how your examiner is liberal. You see, like your examiner, when they're marking the whole of this, they'll tell you like any six at 2, and then you get your 12 marks in full. Or any 5 at 2, you get your 10 marks. So you don't need like your account to balance. Actually, balancing can be very, very costly. Balancing a question can be very, very costly for you in terms of what? In terms of time. All right. So then when I come now in my next session, my role will be now to show you like how do you harvest low-hanging fruits. So for the students who had attempted this question and they were able to balance nicely, who do you think deserves my present this afternoon? Look at your workings. Somebody on WhatsApp, because you have done this on WhatsApp, who do you think in this case here deserves my present? 1,000 bob. So then we shall be able to take that debate on WhatsApp. We shall be able to take that debate on WhatsApp. I don't know where this gentleman went wrong. You see, our total assets are balancing at 23,600. The ones that we have done up there, 23,600. This gentleman should be able to check where he's lost 100 bob. Could be somewhere there. Could be somewhere there. Or in your assignment. Great. Then you really tried. Otherwise, thank you very much. Sorry for extending this session. It's my hope that as you progress, you guys are making progress. You're making progress as you progress like that. You are getting to understand this even more.